Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and entertainment purposes only. The information provided is based on general principles and research for a United States audience. Your individual insurance needs are unique, and policies can vary significantly by state and provider. Always consult with a qualified and licensed professional before making any financial decisions or changes to your insurance coverage. Let me tell you about a woman named Jessica from Texas. For 10 straight years, Jessica was the perfect driver. A clean record. Not a single speeding ticket, not a fender bender, nothing. She paid her insurance premium on time, every 6 months like clockwork. And every time she felt secure, because she had what her agent always called full coverage. She was paying for the best, the top-tier plan. She was protected, or so she thought. One evening, driving home from work, a driver ran a red light and slammed directly into her driver's side door. The crash was violent, and it was a miracle she only had a broken arm and severe whiplash. Her car, a 3-year-old SUV she was still making payments on, was completely totaled. But Jessica wasn't worried about the money. She had full coverage. That's when her perfect world started to crumble. The other driver? He had the absolute bare minimum insurance required by the state of Texas. A policy that would barely cover a fraction of Jessica's medical bills, let alone her totaled car. So Jessica called her own insurance company, confident they would make it right. And that's when she learned the devastating truth. The truth is that full coverage is probably the most dangerous and misleading phrase in the entire insurance industry. It's a myth, a piece of marketing slang that has tricked millions of Americans, just like Jessica, into a false sense of security. And it's a myth that could be costing you thousands of dollars right now, or worse, could lead to your financial ruin when you need that protection the most. Over the next few minutes, we are going to tear down the 5 biggest car insurance myths that are draining bank accounts all across America. I'm not just going to tell you they're false. I'm going to show you exactly why they're false, how the industry uses them to its advantage, and what you need to do step by step to arm yourself with the truth. By the end of this video, you will be able to look at your own policy with a new set of eyes, have an intelligent, informed conversation with your agent, and potentially save yourself from a financial catastrophe like the one Jessica faced. So let's start with the big one. Myth number 1. I have full coverage, so I'm protected from everything. I want you to burn this into your brain. There is no such thing as a full coverage policy. It does not exist. It is not a legal or technical term. It's a convenient, lazy shorthand that people use, and it's dangerously vague. When an agent or a car dealer says full coverage, what they usually mean is a policy that bundles 3 basic types of coverage together. Let's break them down. First, you have liability coverage. This is the one that's legally required in almost every state. But here's the critical part. Liability does not cover you. It does not cover your car. It doesn't cover your medical bills. Liability coverage pays for the other person's car and the other person's medical bills when an accident is your fault. So if you rear-end someone, your liability insurance pays to fix their bumper and cover their doctor's visit, up to your policy limits. It does absolutely nothing for you. Second, you have collision coverage. This is the part that pays to repair or replace your car if it's damaged in a collision with another vehicle or an object, like a telephone pole or a guardrail. Pays out regardless of who is at fault. If you cause the accident, it pays. If the other person causes it, it pays. If a UFO crashes into you, it pays. But, and this is a big but, it comes with a deductible. That's the amount of money you have to pay out of your own pocket before the insurance company pays a single penny. A common deductible is $500 or $1,000. So if you have a $1,000 deductible and cause $3,000 in damage to your car, you pay the first $1,000, and the insurance company pays the remaining $2,000. Third, you have comprehensive coverage. This is sometimes called other than collision coverage. This protects your car from damage caused by things like theft, vandalism, fire, hail, flooding, or hitting an animal. Just like collision, comprehensive also has a deductible you have to pay first. So, liability, collision, and comprehensive. That's the holy trinity of what people call full coverage. It sounds pretty good, right? It sounds like you're covered. But this is exactly where the myth becomes so dangerous. It's not what full coverage includes that can destroy you financially. It's what it leaves out. Let's go back to Jessica. Her full coverage policy had all 3. But remember, the guy who hit her was underinsured. His pathetic liability policy only covered the first $25,000 of her medical bills. But her hospital stay, surgery for her arm and months of physical therapy were projected to cost over $80,000. So where does the other $55,000 come from? She assumed her full coverage would pick up the rest. It didn't. Why? Because she was missing uninsured and underinsured motorist protection. This is an optional coverage in many states, and it is arguably one of the most important coverages you can buy. It protects you when the at-fault driver has no insurance or not enough insurance to cover your costs. Because Jessica didn't have it, she was suddenly on the hook for a mountain of medical debt. Debt that was caused by someone else's mistake. But her nightmare was just getting started. Her car was totaled. The insurance company determined its actual cash value was $19,000. The problem? Jessica still owed $23,000 on her car loan. This is called being upside down or underwater, and it's incredibly common. Her collision coverage paid out the $19,000, minus her $1,000 deductible, so she got a check for $18,000. She paid that to the bank, but she still owed them a $5,000 difference. So now Jessica had no car, a mountain of medical bills, and was still forced to write a check for $5,000 to a bank for a pile of scrap metal that no longer existed. This could have been completely avoided if she had one simple add-on: gap insurance. Gap insurance is specifically designed to cover the gap between what your car is worth and what you still owe on it. It's usually inexpensive, but it's not automatically included in full coverage. And the final blow? While all of this was happening, Jessica still had to get to work. She needed a car. She called her insurance company and asked about the rental car they would provide. The agent on the phone was polite but firm. "I'm sorry, ma'am, but you don't have rental reimbursement coverage on your policy." That's right. Another separate, optional coverage that costs maybe $5 or $10 a month. Because she didn't have it, she had to pay for a rental car out of her own pocket for weeks, adding another $1,000 to her growing financial disaster. Do you see it now? Jessica paid for full coverage for a decade, believing she was safe. But that simple, misleading phrase hid the truth. It hid the gaps in her policy. No underinsured motorist protection, no gap insurance, no rental reimbursement. 3 small, inexpensive add-ons that would have saved her from financial ruin. So here is your mission. As soon as this video is over, I want you to pull up your auto insurance policy. You can find it on your insurer's website or app. It's called the Declarations page. Look for the words full coverage. I guarantee you will not find them. Instead, you're going to look for the specific line items. Do you have collision? Do you have comprehensive? What are your deductibles? What are your liability limits? And most importantly, look for the gaps. Do you have uninsured/underinsured motorist bodily injury? Do you have gap insurance if you have a loan? Do you have rental reimbursement? Don't ever again accept the phrase full coverage from anyone. Instead, you need to ask targeted, scenario-based questions. Ask your agent, what happens if I'm hit by a driver with no insurance and end up in the hospital? Am I covered? Ask them, if I total my car tomorrow and I still owe more than it's worth, what happens? The answers to those questions will tell you the real story of your coverage. The truth is in the details, not in the marketing slang. And understanding that difference is the first, most critical step to protecting yourself and your family. But this is just the beginning. The next myth we're going to bust is one that affects the color of the car you drive. And the truth behind it is not what you think. You've heard it a million times, maybe from a parent, a well-meaning friend, or just as a piece of common knowledge floating around the internet. Buy a red car, and your insurance premium will skyrocket. The logic seems almost intuitive, doesn't it? Red is the color of passion, of aggression, of stop signs and fire engines. It's the color of speed. We picture a cherry red sports car, a blur on the highway, and we instinctively connect that color to risk. Feels true. Feels like it should be true. And that feeling is precisely why this myth has survived for decades, costing people peace of mind and, in some cases, preventing them from buying the car they truly want. But today we're going to put that feeling on trial. We're going to pull back the curtain on what insurance companies actually see when they look at your car. And I can tell you right now, they are completely colorblind. Let me be absolutely, unequivocally clear. The color of your car has zero direct impact on your insurance premium. Not red, not yellow, not arrest me orange. Zero. When you apply for an insurance quote, the agent or the online form will ask for a lot of information. They'll want your name, your address, your driving history, and most importantly, they will want your car's vehicle identification number, the VIN. That 17-digit code is your car's DNA. It tells the insurer everything they need to know: the make, the model, the year it was manufactured, the type of engine under the hood, the body style, and even the factory where it was assembled. What is not included in that VIN? The paint code. They don't ask for it and they don't care about it. So if they don't care about the color, what do they actually care about? The answer is data. Cold, hard statistical data that predicts one thing: risk. They are in the business of betting on your future, and they use your car's profile to stack the odds in their favor. First and foremost is the make and model. This is the big one. A 2023 Porsche 911 and a 2023 Honda CR-V might be the exact same shade of Guards red, but their insurance premiums will be in different universes. The Porsche is a high-performance machine with a massive engine, built for speed, and incredibly expensive to repair. The CR-V is a family-friendly SUV known for its safety and reliability. The insurer's database, compiled from millions of claims over the years, shows that Porsche 911 drivers, as a group, get into more frequent and more expensive accidents than Honda CR-V drivers. It's not a judgment on you personally. It's a statistical reality they cannot ignore. Next is the car's specific profile. The engine size is a huge factor. A V8 muscle car will always cost more to insure than its V6 or 4-cylinder counterpart, because more horsepower statistically correlates with more risk. The body type matters too. A 2-door coupe is often seen as sportier and is involved in more claims than a 4-door sedan of the very same model. Then there's the data you might not even think about, like theft rates. For years, cars like the Honda Accord and full-size Ford and Chevy trucks have topped the list of most stolen vehicles in America. If you own a car that is a magnet for thieves, your insurer sees that as a higher risk of a comprehensive claim, and your rate will reflect that. Conversely, a car loaded with anti-theft technology might earn you a small discount. And finally, there's the cost of repair. This is a massive and often hidden driver of insurance costs. A minor fender bender in a 15-year-old Toyota Camry might cost a few $100s to fix. That same fender bender in a brand new luxury SUV, with its matrix LED headlights, embedded parking sensors, and advanced driver assistance cameras in the bumper, could easily turn into a 5-figure repair bill. Your insurer knows the average repair costs for every single model, down to the last dollar, and they price your policy accordingly. So, if all of this is true, why does the red car myth refuse to die? The answer lies in a simple but powerful psychological trap: the confusion of correlation with causation. Think about it. What kinds of cars are most often painted bright, flashy red? Sports cars, muscle cars, high-performance models, cars like the Ferrari, the Corvette, the Mustang. And what do all of those cars have in common? They have massive engines, they are expensive to repair, and they have a history of being driven in a way that leads to more claims. Therefore, they have incredibly high insurance premiums. So people see a red Corvette with a high insurance rate. Then they see a red Mustang with a high insurance rate. And they make a mental leap, connecting the one thing they have in common, the color, to the high price. They mistake the correlation for the cause. It's like saying that ice cream sales cause shark attacks. In the summer, ice cream sales go up and shark attacks also go up. But one doesn't cause the other. They are both correlated with a third factor: warm weather and more people at the beach. In our case, the red paint isn't causing the high premium. The red paint is simply a popular choice for the type of high-risk vehicle that was already destined to have a high premium. A black Ferrari will cost the same to insure as a red Ferrari. A boring beige Corvette will have the same astronomical rate as a fire engine red one. The insurer is rating the car, not its complexion. Now, there is a tiny sliver of truth buried in this myth, and it has to do with getting pulled over. Some studies have suggested that brighter colored cars, including red, receive slightly more traffic tickets. But even this is misleading. The leading theory isn't that police officers are specifically targeting red cars. It's that a brightly colored car is simply more visible. If two cars are speeding, and one is a muted gray that blends in with the asphalt while the other is a vibrant red, the officers might be drawn to the red one first. But let's be real. If you're doing 95 and a 65, the color of your car is the least of your problems. The ticket you receive will absolutely raise your insurance rates, but it's the violation on your driving record that's doing the damage, not the fact that your car was red when you got caught. The ultimate takeaway here is to free yourself from this myth. If you find the perfect car and it happens to be red, buy it. Don't spend a single second worrying that the color will penalize you. Instead, focus your energy on the factors that truly matter: Here's the single most valuable piece of advice I can give you when you're car shopping. Get insurance quotes before you buy the car. Don't wait until you've signed the papers and fallen in love with your new ride. Pick your top 3 or 4 choices, call your insurance agent, and get a hard quote for each one. You might be shocked to find that 2 seemingly similar compact SUVs have a difference of hundreds of dollars a year in insurance costs, simply because one has a higher theft rate or is more expensive to repair. A 10-minute phone call can reveal the hidden cost of ownership and save you thousands of dollars over the life of your loan. You're not just buying a car, you're buying a whole package of expenses, and insurance is one of the biggest. So, the color of your car is off the table. Insurers care about the VIN, not the paint job. But what they care about even more is you. And that brings us to our third, and perhaps most controversial myth: the idea that your credit score has nothing to do with what you pay for your car insurance. You might think your financial history is your own business, but in the eyes of an insurer, it tells a story they are desperate to read. And how they use that story against you is something you absolutely need to know. It all comes down to a single, powerful, and deeply controversial idea: correlation. Insurance companies have spent billions of dollars building statistical models that analyze massive pools of data, and they found a strong correlation between a person's financial behavior and their likelihood of filing an insurance claim. They aren't necessarily saying that someone with a low credit score is a bad driver. They're saying that, statistically speaking, people in that group are a higher risk. This brings us to the second major myth we need to shatter. Myth number 2. My driving record is the only thing that matters for my car insurance rate. This is one of the most logical and therefore most dangerous myths out there. It makes perfect sense. Car insurance is for cars. It should be about how you drive them. If you're a safe driver with no accidents and no tickets, you should get the best rate. Period. But that's not the world we live in. Your driving record is just one chapter in the story an insurer writes about you. And frankly, it's often not even the most important one. The main character in their story? It's something called your credit-based insurance score. Now, this is not the same as the FICO score you use to get a mortgage or a credit card, but it's built from the same raw material. Your credit report. They look at your payment history, your outstanding debt, the length of your credit history, and any recent applications for new credit. They plug this into their own secret algorithm and out pops a number that predicts how likely you are to cost them money. Let me paint you a picture. Meet Mark. Mark is, by every definition, a perfect driver. He's 45 years old, has been driving since he was 16, and has never had a single at-fault accident. Not one. He's never gotten a speeding ticket. He drives a 10-year-old silver Honda Accord about as safe and non-threatening as a car gets. He commutes 20 minutes to his office job every day on the same boring route. By all logic, Mark should be paying rock-bottom prices for his insurance. Now meet Jessica. Jessica is the same age, lives in the same town, and drives a similar car, a Toyota Camry. She's also a good driver, but her record isn't as spotless as Mark's. She had a minor fender bender about 5 years ago. One of those low-speed parking lot incidents. Technically, it was her fault. So, who do you think pays more for car insurance? The answer, in most states, is Mark. And by a lot. Sometimes hundreds of dollars more per year. Why? Because 5 years ago, Mark's wife had a serious medical emergency. It led to a mountain of debt, and for a while Mark struggled. He was late on a few credit card payments and his credit score took a massive hit. He's since recovered financially, but that blemish is still on his credit report. Jessica, on the other hand, has an 820 credit score. She's never missed a payment on anything in her life. To an insurance company, Mark's perfect driving record is overshadowed by his past financial struggles. Their data tells them that a person with Mark's financial profile, regardless of their driving history, is more likely to file a claim. Not necessarily a claim for a big spectacular crash. Could be for anything. A cracked windshield. A small dent from a runaway shopping cart. They believe people under financial pressure are more likely to file small claims they might otherwise pay for out of pocket, or in the worst-case scenario, even commit insurance fraud. So the insurer isn't looking at Mark, the safe driver. They're looking at a statistical ghost, a risk profile compiled from millions of other people who happen to share some of his financial data points. He's being judged not for his actions behind the wheel, but for his circumstances. This practice is, to put it mildly, incredibly controversial. Proponents, mainly the insurance industry itself, argue it's the most accurate way to predict risk, which allows them to set fairer prices for everyone. They claim that without it, low-risk customers like Jessica would end up subsidizing high-risk customers, and everyone's rates would go up. But critics, which include many consumer advocacy groups, see it very differently. They see a system that punishes the poor. It creates a devastating feedback loop. You lose your job, your credit suffers. Because your credit suffers, your car insurance bill, a mandatory expense for most Americans to get to work, suddenly goes up. This makes it even harder to get back on your feet. It penalizes people for life events that are often completely out of their control, like a medical crisis, a divorce, or being laid off. It has nothing to do with personal responsibility on the road. Because of this, a few states have taken a stand. California, Hawaii, and Massachusetts have banned the use of credit information in setting car insurance rates. In those states, Mark's perfect driving record would actually earn him the low rate he deserves. But for the vast majority of the country, your financial health is inextricably linked to your insurance premium. And this is just the tip of the iceberg. The myth that only your driving record matters is so wrong because insurers are looking at a whole constellation of data points that have nothing to do with your driving. Take your zip code. You could be the safest driver in the world, but if you move 2 blocks over into a different zip code, your insurance rate could skyrocket by 30 or 40%. Why? Because your new neighborhood has slightly higher rates of car theft, vandalism, or accident claims. It doesn't matter that you park your car in a locked, private garage every night. You are being judged by the statistical behavior of your neighbors. Then there's your age and marital status. Young drivers, particularly males under 25, pay astronomical rates. This isn't because every 19-year-old is a reckless driver. It's because, as a group, they are statistically more likely to get into accidents. On the flip side, once you get married, you'll often see your rates go down. The actuarial tables suggest that married people are more stable and less risky. Your decision to tie the knot is, in the eyes of your insurer, a relevant data point for how you'll behave on the road. Even your occupation can play a role. An engineer might get a better rate than a delivery driver, not because of their individual driving habits, but because of the insurer's assumptions about the stress, mileage, and risk associated with their profession. So what does this all mean? It means your car insurance premium is not a simple reflection of your skill as a driver. It's a complex, often invasive, and sometimes deeply unfair risk assessment. You're not just a driver, you're a demographic profile. You are a collection of data points: your credit, your address, your age, your job, your marital status, all fed into a machine that calculates the odds that you will cost them money. Your clean driving record is a nice bonus, but it's swimming in a sea of other factors that can easily overwhelm it. They're not just judging your wallet, they're judging your life choices, right down to your zip code and marital status. But the profiling doesn't stop there. Insurers have been accused of using even more superficial details to hike your rates. Take the color of your car, for instance. We've all heard the rumor that red cars cost more to insure. Is it just another myth? Or is there a kernel of truth in the idea that your choice of paint job could be costing you hundreds of dollars a year? The answer is more complicated and far more interesting than you think. Let's just get this out of the way right now. The idea that a red car, simply by virtue of being red, will get you a higher insurance quote is unequivocally 100% false. It is a complete and total myth. When you apply for car insurance, the agent or the online form will ask for a mountain of information. They'll want your name, your age, your address, your driving history, your credit score in most states, and of course the details of your car. They'll ask for the year, the make, the model, the body style, the engine size, and most importantly, the 17-digit vehicle identification number, or VIN. The VIN is like your car's DNA. It tells an insurer everything they need to know about its history and specifications. But you know what question you will never ever be asked? What color is it? It's not on the application. It's not in their pricing algorithm. An insurance company simply does not care if your car is race red, grabber blue, or boring beige. A 2023 Toyota Camry LE in supersonic red costs the exact same to insure as a 2023 Toyota Camry LE in celestial silver metallic, all other factors being equal. So, if it's so demonstrably false, why does this myth have such incredible staying power? Why has it been passed down from parents to children for generations, spoken as gospel in diners and garages across America? The reason is that the myth isn't born from insurance data, but from human psychology. The color red is hardwired into our brains to mean something. It's the color of stop signs, of fire trucks, of blood, of warning labels. It signals urgency, danger, and commands attention. And in the automotive world, what is red associated with? Speed, power, aggression. Think of the most iconic sports cars. What color comes to mind? Ferrari red. A Guards red Porsche. A Viper in adrenaline red. We associate the color with high-performance machines and, by extension, with a certain type of driver, someone who is perhaps a bit more of a risk-taker, someone who enjoys being noticed, someone who might have a slightly heavier foot on the gas pedal. And this is where we find that kernel of truth we were looking for. While the insurance company doesn't care about your car's color, the world around you does. And that can have a very real and very expensive indirect effect on your insurance rates. It's a classic case of correlation, not causation. Imagine two drivers, we'll call them Alex and Ben. They are, for our purposes, identical twins. Same age, same job, same clean driving record, they even live in the same house. They both decide to buy a brand new Ford Mustang GT. Alex, being a bit more low-key, opts for the sleek, understated carbonized gray. Ben, who loves the attention, goes for the loudest, most vibrant paint color on the lot, race red. They both call their insurance company on the same day to get a quote. And to Ben's surprise, they get the exact same price. The agent doesn't care about the color, only that it's a Mustang GT. Fast forward 1 year. Alex's insurance premium has barely changed. Ben's, however, has shot up by 30%. What happened? Did the insurance company find out his car was red and penalize him? No. What happened was human nature. Both Alex and Ben like to drive fast sometimes. They both occasionally push it to 10 or 15 miles per hour over the speed limit on the highway. But when Alex does it in his muted gray car, he blends in. He becomes part of the river of metallic grays, blacks, and whites that dominate American roads. He is, for all intents and purposes, part of the camouflage. But when Ben does the exact same thing in his screaming red Mustang, he sticks out like a sore thumb. Think about it from the perspective of a state trooper sitting on the median. Their eyes are scanning hundreds of cars a minute. What are they going to notice first? The anonymous gray sedan? Or the flash of brilliant red that looks like it's going fast even when it's standing still? It's not a conscious bias. It's just basic visual perception. Bright, saturated colors grab our attention. So, over the course of the year, Ben gets pulled over twice for speeding. Alex, who was driving just as fast but less conspicuously, gets pulled over 0 times. Those 2 tickets on Ben's record are now a huge red flag to his insurance company. He is no longer seen as a safe driver. He's now statistically more likely to be in an accident, and his premiums skyrocket to reflect that new, higher risk. The car's color didn't directly cause the rate hike. The speeding tickets did. But the color made it significantly more likely that his speeding would be noticed and punished. The red paint didn't make his insurance more expensive. It made his behavior more expensive. So, the myth survives because there's a sliver of observable reality to it. People see their friend with a red sports car paying a fortune for insurance and make the easy but incorrect connection. They blame the paint, not the points on the license. If the color is a red herring, what actually matters about the car itself when it comes to your premium? The answer is everything else. Insurers are, at their core, data companies. They have decades of information on nearly every car ever made, and they use it to predict how much your specific vehicle will cost them in the future. First, and most obviously, is the car's sticker price and repair cost. A brand new Mercedes-Benz S-Class is going to cost a fortune to insure compared to a 10-year-old Honda Civic. If you total that Mercedes, the insurance company is on the hook for a 6-figure payout. If you total the Civic, it's a much smaller check. But it goes deeper than that. They have data on the cost of individual parts. The complex LED headlight assembly on a modern luxury SUV can cost $3,000 to replace after a minor fender bender. The equivalent part on an economy car might be $300. Insurers know this, and they price your collision coverage accordingly. Second is theft rate. Some cars are magnets for thieves. Year after year, full-size trucks like the Ford F-150 and Chevy Silverado, along with popular sedans like the Honda Accord and Civic, top the list of most stolen vehicles in America. If you own a car that's on that list, you represent a higher risk of a total loss theft claim, and your comprehensive coverage premium will reflect that. It has nothing to do with how you drive. It's about how desirable your car is to criminals. Third, and this is a big one, is safety. Insurance companies love safety. They pour money into the Insurance Institute for Highway Safety, or IIHS, for a reason. A car that earns a Top Safety Pick Plus award is a car that's been proven to protect its occupants in a crash. That means you're less likely to be seriously injured, which in turn means the insurer is less likely to have to pay out hundreds of thousands of dollars in medical bills under your personal injury protection or medical payments coverage. A car with advanced driver assistance features like automatic emergency braking and blind spot monitoring is statistically less likely to be in an accident in the first place. Driving a safer car doesn't just protect your life, it directly saves you money on your insurance. Finally, there's the performance profile. This is the part that people correctly associate with sports cars, but misattribute to the color. A car with a powerful V8 or turbocharged engine has a higher potential for speed and acceleration, which correlates with more frequent and more severe accidents. It's not a judgment on you as a driver, it's a simple statistical reality. More horsepower tends to equal more risk in the eyes of an underwriter. That's why a V8-powered Mustang GT costs significantly more to insure than the base 4-cylinder EcoBoost model, even if they look nearly identical. So we've established that the color of your car is a distraction, a convenient but incorrect explanation for why insurance rates can be so high. The real factors are buried in data about repair costs, theft statistics, safety ratings, and engine power. But this brings up an even bigger question about who or what is actually being insured. When you hand your keys to a friend to borrow your car for the weekend, what happens if they get into an accident? Most people assume their friend's insurance will cover it. After all, they were the one driving. But that assumption could be the single most expensive mistake you ever make. The truth about whether insurance follows the car or the driver is a legal minefield that could leave you bankrupt. And it all hinges on one simple question. When your friend crashes your car, whose insurance pays? The answer most people give is wrong, and that mistake can cost you everything. Let's talk about Mark. Mark just bought his dream car, a brand new fully loaded SUV. He was proud of it, meticulous about it. His college buddy Kevin was in town for the weekend and needed to run some errands across the state. Kevin had his own car, his own insurance, and a clean driving record. So when he asked to borrow Mark's new SUV for the trip, Mark didn't hesitate. "Sure, man," he said, tossing him the keys. "Just be careful with her." He figured if the worst happened, Kevin's insurance would handle it. After all, Kevin would be the one behind the wheel. That was the biggest financial miscalculation of Mark's entire life. Saturday afternoon, Mark's phone rang. It was a state trooper. There had been an accident. A bad one. On the interstate, Kevin had looked down at his GPS for just a second too long. When he looked up, traffic was stopped. He slammed on the brakes, but it was too late. He rear-ended a minivan, pushing it into a luxury sedan, which then clipped a motorcycle. A chain reaction of twisted metal and shattered glass. People were injured. Ambulances were on the scene. The highway was shut down. Mark's heart sank, but a small part of him felt a wave of relief. Kevin was okay, and Kevin had insurance. This was Kevin's problem to solve. But when the first insurance claim letter arrived a week later, it wasn't addressed to Kevin. It was addressed to Mark. And it was from his insurance company. That's when Mark's world began to unravel. He learned the brutal truth that shatters one of the most common and dangerous car insurance myths in America. The myth is that insurance follows the driver. The reality is, in almost every state, with very few exceptions, your car insurance follows your car. Think of your insurance policy as a protective bubble that surrounds your vehicle. When you give someone permission to drive your car, you are giving them permission to step inside that bubble. You are effectively lending them your car and your insurance policy. This is a legal principle called permissive use, and it means your insurance is now on the line. It is the primary coverage. The driver's insurance, if they have any, is secondary. Let's break down what this meant for Mark. The total damage to the other vehicles in the pileup was estimated at over $180,000. Mark had what he thought was good coverage. He had a $100,000 limit for property damage liability. So, his insurance company wrote a check for $100,000, maxing out his policy instantly. That still left an $80,000 bill for the remaining vehicle damage. Now, Kevin's secondary insurance kicked in. Thankfully, Kevin also had a $100,000 property damage limit, so his policy was able to cover the remaining $80,000. On the property side, they were covered, but the property was the cheap part. 3 people in the other vehicles had been seriously injured, with medical bills that were already soaring past $500,000 and were expected to climb. Mark's policy had a bodily injury liability limit of $100,000 per person and $300,000 per accident. His insurance company immediately notified him they would be paying out the full $300,000 limit. That left at least $200,000 in medical bills completely unpaid. Kevin's secondary policy had a bodily injury limit of only $50,000 per person. paid that out, but it was a drop in the ocean. There was still a massive, terrifying $150,000 shortfall, and the injured parties, facing their own life-altering circumstances, needed to be compensated. So they hired lawyers. And who did the lawyers come after? They came after everyone. They sued Kevin, the driver, for negligence. And they sued Mark, the owner, for vicarious liability, a legal term meaning he was responsible for the actions of the person he allowed to use his property. Suddenly, Mark was named in a lawsuit for hundreds of thousands of dollars. The life he had built, his savings account, the equity in his home, his future earnings, it was all at risk. He was facing financial ruin, all because he tossed his keys to a friend, armed with the false confidence of a myth. Even if, by some miracle, the insurance policies had been enough to cover all the damages, Mark's ordeal would be far from over. His insurance company just paid out $400,000 on his policy because of an accident caused in his car. In the eyes of the insurance industry, that accident is now attached to his record, to his policy. When his renewal came up, his premiums didn't just go up, they exploded. He was recategorized as an astronomically high-risk client. Or, even worse, his insurer could simply choose to non-renew his policy, dropping him as a customer altogether. Now he's stuck trying to find new insurance with a catastrophic, multi-injury, at-fault accident on his record. The rates he'd be quoted would be punishing, a financial penalty he would pay for years and years. This is the core lesson. When you lend your car, you are lending your financial security. Now, like any rule, there are critical exceptions you need to know. What if someone drives your car without your permission? If your car is stolen, or a joyriding teenager takes it without you knowing, that's non-permissive use. In that case, the responsibility typically falls on the driver's insurance policy, if they have one. But be warned, proving it was non-permissive can be a brutal, uphill battle, especially if it's a family member or a roommate who has used the car before. The insurance company will investigate, and if they find any reason to believe you've given implied consent in the past, they will fight to make your policy pay. Another huge exception is the named driver exclusion. Some people, to save money on premiums, will specifically exclude a high-risk driver in their household from their policy. For instance, a son with 2 DUIs. If you have officially excluded that person and they get behind the wheel of your car and crash, your insurance will provide zero coverage. It's as if the car was uninsured at that moment. The liability would fall entirely on the driver and, ultimately, on you as the owner. And here's a modern trap: business use. Let's say your friend borrows your car to deliver for DoorDash or drive for Uber for a few hours to make some extra cash. If they get into an accident while doing that, your personal auto policy will almost certainly deny the entire claim. Personal policies have a strict exclusion for any commercial or business-related use. The moment your car is used to make money, that protective bubble from your personal insurance pops. So what do? The answer isn't to never let anyone borrow your car again. The answer is to do it with your eyes wide open. Before you hand over your keys, you are no longer just a friend. You are an underwriter. You are assessing risk. Ask yourself, do I trust this person's judgment behind the wheel? Do they have a good driving record? Crucially, do they have their own insurance and are their liability limits high? It might feel awkward, but it's a fair question to ask. An honest friend will understand. Have the conversation. Say, hey, just so we're on the same page, if anything happens, it's my insurance that's on the hook first. So please be incredibly careful. That one sentence can change the way they drive your car. It's a moment of discomfort that can save you from a decade of financial pain. And most importantly, look at your own policy. Look at your liability limits. The state minimums are a joke. They are designed to protect other people from you, not to protect you from financial ruin. If you cause a serious accident, those minimums will be exhausted in seconds. You need limits that protect your assets, your savings, your home. For most people, that means at least $250,000 per person and $500,000 per accident. And if you have significant assets, you absolutely need to look into an umbrella policy, which adds an extra $1 million or more of liability coverage on top of your auto and home insurance for a surprisingly low cost. The simple act of tossing your keys is an act of immense trust, not just in your friend's driving, but in their ability to protect your entire financial future. The myth that it's their problem is a fantasy. In the real world, the keys in your hand are tied directly to your wallet, and once you let them go, you're no longer in the driver's seat. This leads us directly to another myth that lulls drivers into a false sense of security, the one about what your insurance must cover after an accident. And that brings us to myth number 3. If my car is damaged, my insurance company has to pay for brand new, original parts from the manufacturer. It just feels right, doesn't it? You bought a Ford, you pay your Ford-level insurance premium. So if someone smashes your fender, you expect a genuine Ford fender to replace it. Not some knockoff. Not a part pulled from a wreck in a junkyard. You expect your car to be made whole again, exactly as it was before the crash. It's a matter of quality, of safety, of resale value. You're paying for a promise to restore what was lost. And in your mind, that promise is sealed with the automaker's logo stamped onto the replacement part. To suggest anything less feels like a bait and switch. It feels like the insurance company is cutting corners on your car to save a few bucks for their bottom line. And for millions of drivers who have been in this exact situation, that feeling of betrayal is all too real. But here's the cold, hard truth buried in the fine print of your policy. That promise you thought you bought probably isn't what you think it is. In nearly every standard auto insurance policy in the United States, there's a little clause, a few innocent-looking words that give your insurer immense power. It usually says they have the right to repair your vehicle with parts of like, kind, and quality. Like, kind, and quality. Or LKQ as it's known in the industry. That phrase is the legal escape hatch that allows them to use parts that are not brand new. And not from your car's original manufacturer. Let's break down what that actually means. It opens the door to 3 types of parts. First, you have OEM parts, original equipment manufacturer. These are the parts your car was built with, the ones with the Ford, Toyota, or BMW logo. They are the most expensive. Second, you have aftermarket parts. These are copies made by third-party companies. Their quality can range from excellent, sometimes even better than the original, to downright terrible. They might not fit perfectly, their materials could be cheaper, and they might not have undergone the same rigorous safety testing. And third, you have recycled or salvaged parts. These are OEM parts taken from other vehicles, usually from total loss cars in a salvage yard. They are original, but they are used. Why does your insurer want to use these other parts? The answer is simple and brutal: money. A new OEM bumper might cost $1,000. A certified aftermarket bumper could be $600. A recycled one from a salvage yard? Maybe $400. When you multiply that savings by millions of claims every year, we're talking about billions of dollars in savings for the insurance industry. Billions. Their legal obligation isn't to make your car perfect again. It's to restore it to its pre-accident condition in the most cost-effective way allowed by your policy. And that little phrase, like, kind, and quality, is their golden ticket to do just that. Let's make this real. Meet Sarah. Sarah drives a 3-year-old Honda CR-V. It's her pride and joy, reliable, safe, and she plans to drive it for another 10 years. One afternoon, sitting at a red light, bam! A driver texting on their phone rear-ends her. It's not a terrible crash, but the back bumper is cracked, the tailgate is dented, and one of the taillights is shattered. The other driver is at fault, their insurance is handling it, everything seems straightforward. Sarah does what she thinks is right. She takes her CR-V to the certified Honda dealership's body shop. They know her car inside and out. They write up an estimate for the repairs, specifying all new genuine Honda parts. The total comes to about $4,500. A few days later, she gets a call from the other driver's insurance adjuster. The call does not go well. The adjuster informs her that they have reviewed the estimate, and they will not be approving the new Honda parts. Instead, they will only pay for an aftermarket bumper, a recycled tailgate from a salvaged CR-V, and an aftermarket taillight. This new estimate, using these LKQ parts, is only $2,900. A $1,600 difference. Sarah's furious. This isn't right, she says. I want my car fixed properly. I want real Honda parts. The adjuster calmly replies, Ma'am, our policy and the law allows us to use parts of like, kind, and quality. These parts are certified and come with a warranty. They will restore your vehicle to its pre-loss condition. Sarah feels trapped. The dealership's body shop manager warns her that aftermarket bumpers sometimes have fitment issues, with uneven gaps. He tells her the recycled tailgate they found is the right color, but it's from a vehicle with 50,000 more miles on it than hers. She's worried about safety. Will that aftermarket bumper crumple the same way in another crash? Will the sensors inside it work correctly? She's worried about her car's value. When she goes to sell it in a few years, a trained eye will spot the non-OEM parts, potentially lowering its resale value by thousands. This is the nightmare scenario that plays out every single day across the country. Drivers like Sarah feel powerless, caught between a body shop telling them one thing and an insurance company, holding all the money, telling them another. So what can you do? Are you completely at their mercy? No. You have options, but you have to be proactive. First, and this is the most crucial step, you have to become your own advocate before you ever have an accident. When you're shopping for insurance, ask the agent directly. What is your policy on using OEM versus aftermarket parts? And then, ask about something called an OEM endorsement or rider. This is an optional coverage you can add to your policy. Yes, it will cost you a little more, maybe $50 to $100 a year, but it guarantees that for a certain number of years, if your car is in a wreck, the insurance company must use new, original equipment manufacturer parts for the repair. For anyone with a car that's less than 5 years old, or a luxury vehicle, or a car you're just passionate about keeping in pristine condition, this endorsement is one of the single best investments you can make in your auto insurance. Second, know your rights. State laws vary dramatically on this. Some states have very few protections for consumers. Others, however, are much stricter. For example, some states require the insurance company to get your written consent before using non-OEM parts. Some states prohibit the use of aftermarket parts on a car that's only a year or two old. Some states mandate that any non-OEM part must be clearly identified on the repair estimate. A quick Google search for your state auto insurance aftermarket parts law can arm you with critical information. Don't let an adjuster tell you, the law says, when you haven't checked for yourself. And third, if you're in the middle of a claim like Sarah, don't just roll over. The phrase is like kind and quality. If the body shop tries to install an aftermarket fender and it doesn't line up, if the gaps are wrong, if the paint doesn't match perfectly, that is not of like quality. You and your chosen body shop have the right to reject that part. Document everything. Take pictures. Have the shop manager write a letter explaining why the part is inferior. Escalate the issue to a supervisor at the insurance company. Often, if they are faced with a well-documented, legitimate quality issue, they will back down and approve the OEM part, rather than risk a lawsuit or a complaint to the state's Department of Insurance. You can also choose to pay the difference yourself. In Sarah's case, she could have paid the $1,600 difference to get the genuine Honda part she wanted. It's not ideal, but it's an option to maintain her peace of mind and her car's value. The myth that your car will be magically restored with brand new factory parts is a comforting one, but it's a fantasy for most standard policies. The reality is a battle of cost versus quality, fought in the fine print of your contract. Understanding the rules of this battle, knowing about LKQ, OEM endorsements, and your state laws, is the only way to ensure you don't lose. It's about taking control before you're in a crisis. And speaking of control, it's not just about the parts used to fix your car. It's about controlling the price you pay for the policy in the first place. That brings us to one of the biggest, most controversial, and most misunderstood factors that determines your premium. It's a number that follows you everywhere, and surprisingly, it has absolutely nothing to do with how you drive. Your credit score. Yes, that 3-digit number from Equifax, Experian, and TransUnion that dictates whether you can get a mortgage or a credit card has a massive, and I mean massive, influence on what you pay for car insurance. This brings us to our third major myth. The belief that your driving record is the only thing that really matters. People think, hey, I have a clean record, no accidents, no tickets. My insurance should be dirt cheap. And when it's not, they're left confused and angry, feeling like the system is rigged. And frankly, it's easy to see why. The connection between your financial history and your driving ability feels, well, non-existent. What in the world does your Visa card payment history have to do with your ability to safely change lanes on the interstate? It's one of the most common complaints I hear. It's not fair. And on the surface, that complaint seems completely valid. But to understand why this happens, we have to look past the surface and into the cold, hard world of statistics and risk assessment that insurance companies live in. For them, it's not about judging you as a person. It's about predicting the future. And they have spent billions of dollars analyzing decades of data to find correlations, clues that predict which groups of people are more likely to cost them money. Here's the critical distinction. Insurance companies aren't saying that having a low credit score causes you to be a bad driver. They're saying there is a powerful statistical correlation between a person's credit-based insurance score and the likelihood that they will file a claim. Think of it this way. Data shows that people who buy more ice cream are also more likely to get a sunburn. The ice cream doesn't cause the sunburn. The hot, sunny weather causes people to do both. The two are correlated, not causational. In the same way, insurers argue that the underlying behaviors and life circumstances that lead to a lower credit score Things like financial instability, higher stress levels, or perhaps a tendency to take bigger risks also correlate with a higher probability of filing an insurance claim. It might be more frequent claims or more expensive claims, but the data link is so strong that they can't ignore it. A study by the Federal Trade Commission confirmed this, finding that credit-based insurance scores are effective predictors of risk. They allow insurers to more accurately price their policies, meaning lower-risk consumers, those with good credit, pay less, while higher-risk consumers pay more. So, how does this actually work? Insurers don't just pull your FICO score. They use the information in your credit report to generate something called a credit-based insurance score. It's a different algorithm, but it's built from the same raw materials: your payment history, your level of debt, the length of your credit history, and how often you're applying for new credit. And the impact of this score is staggering. According to industry data, a driver in the United States with poor credit can expect to pay, on average, over 90% more for car insurance than an identical driver with excellent credit. In some states, the penalty is even worse, with rates more than doubling. That means you could be a perfect driver with a spotless record, but because of your financial history, you could be paying $1,000 or more per year than your neighbor who has the same car, but a better credit score. Let's make this real. Imagine a guy named David. David is 45 years old, and he's the safest driver you'll ever meet. He hasn't had a ticket since he was a teenager, and has never been in an at-fault accident. He drives a 10-year-old Honda Accord and follows every rule of the road. By all driving metrics, he is the ideal low-risk customer. But 5 years ago, David's wife had a serious medical emergency. The hospital bills were astronomical, and even with insurance, they were buried in debt. Around the same time, the company David worked for downsized and he lost his job. For over a year, they struggled, living off savings and credit cards. They missed payments. Their accounts went to collections. It was a nightmare. And their credit scores plummeted from the high 700s down into the 500s. Now fast forward to today. David has a great new job, and they're back on their feet financially. They're slowly but surely paying off the old debts and rebuilding. He decides to shop for new car insurance, expecting his perfect driving record to earn him a fantastic rate. The first quote comes back and his jaw hits the floor. It's almost double what he was paying before. He gets another quote and another. They're all sky high. He finally calls an agent and says, "There must be a mistake. I have a perfect driving record." The agent pulls up his file and delivers the bad news. "Sir, your driving record is excellent. The rate is based on your credit-based insurance score." David is a fictional character, but his story is the reality for millions of Americans. They are being penalized not for how they drive, but for financial hardships, often completely outside their control. This is why the practice is so controversial, and in a few states it's actually illegal. As of today, California, Hawaii, and Massachusetts have banned insurers from using credit information to set car insurance rates. Michigan has also passed laws that severely limit its use. So if you live in one of those states, congratulations, this particular myth doesn't apply to you. But for the vast majority of the country, your credit score is a silent, powerful co-pilot determining your insurance destiny. So what can you do about it? You can't just opt out, but you can take control. The first step is to know exactly where you stand. You are legally entitled to a free copy of your credit report from all 3 major bureaus every year from the official government-mandated site, annualcreditreport.com. Get it? Read through every single line and look for errors. A simple mistake, an account that isn't yours, a late payment that was actually on time, could be costing you hundreds of dollars a year. Dispute any errors immediately. The second, more challenging step is to actively improve your credit. The single most important factor is paying every single bill on time, every time. Set up automatic payments so you never miss a due date. Next, focus on your credit utilization. That's the percentage of your available credit that you're currently using. If you have a credit card with a $10,000 limit and a $5,000 balance, your utilization is 50%. You want to get that number as low as possible, ideally below 30%, and even better below 10%. Pay down those balances. Also, avoid closing old credit card accounts, even if you don't use them. A longer credit history is a better credit history, and closing an old account can shorten your average account age and hurt your score. Improving your credit isn't an overnight fix. It's a marathon, not a sprint. But if you spend the next 6 to 12 months focused on these fundamentals, you can see a significant jump in your score. And when you do, it's time to go shopping. Call your current insurer and ask for a re-rating based on your improved credit. Then shop around with other companies. The very same insurer that saw you as a high-risk customer a year ago might now see you in a completely different light and offer you a rate that reflects the safe driver you've always been. So we've established that your financial habits can have a bigger impact on your insurance than a fender bender. But what about something you can't control at all? What about the simple act of getting older? Many people believe that once you hit a certain golden age, your rates are guaranteed to drop and stay low forever. But the reality of how insurance companies view senior drivers is one of the industry's most surprising and frankly most alarming secrets. And this secret is rooted in a cold, hard calculation of risk that feels deeply unfair to millions of the safest drivers on the road. The common wisdom is simple. As you get older, you get wiser. You're no longer the reckless teenager or the distracted 30-year-old juggling kids in the back seat. You're a seasoned, experienced driver. And for a while, your insurance premiums reflect that. From your late 20s through your 50s and even into your early 60s, you are in the insurance industry's sweet spot. You're statistically at your peak driving ability, you're financially stable, and you're less likely to be involved in a serious accident. Your rates drop, year after year, rewarding you for your experience. This is the golden age of car insurance, and it's what cements the myth in our minds. We see the proof on our own bills for decades, but then something changes. Around age 65, the trend starts to slow. By 70, it often plateaus. And for many drivers, by age 75, it begins to reverse course entirely. Suddenly, the renewal notices that used to bring a pleasant surprise now bring a shocking increase. And it's not just a few dollars. We're talking about significant double-digit percentage hikes, year after year, even with a spotless driving record. So what's really going on here? It's not about you personally. It's about statistics. It's about the unblinking, emotionless data that insurance companies live and die by. According to the CDC and the National Highway Traffic Safety Administration, while older drivers tend to drive fewer miles than their younger counterparts, their crash rate per mile driven begins to climb dramatically after age 70. In fact, per mile driven, the fatal crash rate for drivers aged 85 and older is the highest of any age group, even higher than for teenagers. The reasons are purely biological. As we age, natural changes can affect our driving ability. Vision, especially at night, can decline. Hearing loss can make it harder to detect sirens or horns. Reaction times slow down, making it more difficult to respond to a sudden hazard, like a car pulling out or a child running into the street. And perhaps most critically from an insurer's perspective, is the issue of fragility. An accident that a 40-year-old might walk away from with a few bruises could result in broken bones, lengthy hospital stays, and extensive rehabilitation for a 75-year-old. The risk of serious injury or death is simply much higher. This means the potential cost of a claim skyrockets. The insurer isn't just pricing the risk of you denting a fender. They're pricing the risk of a multi-$100,000 medical claim resulting from that same fender bender. Let me tell you about a man named Robert, a retired accountant from Naples, Florida. For 40 years, Robert had a perfect driving record. Not a single at-fault accident. No tickets. He was the guy his friends called the designated driver, even in his 70s. He drove a pristine 10-year-old Buick, mostly to the grocery store, the golf course, and to visit his grandkids. When he turned 76, his 6-month insurance premium, which had been stable for years, jumped by 18%. Robert was furious. He called his agent, a man he'd known for over a decade. "What is this?" he demanded. "I haven't done anything wrong. I drive less than 5,000 miles a year. You should be giving me a discount, not hitting me with an increase." His agent let him vent, then calmly explained the situation. He told Robert, "It's not about you, Bob. It's about the pool you're in now. My system no longer sees you as a 60-year-old with 40 years of experience. It sees you as part of the 75 and over demographic. And the data for that group shows a much higher risk of a very expensive claim." The agent explained that a simple rear-end collision, which might cost the company $5,000 for a younger driver's whiplash treatment, could easily cost over $150,000 for someone in Robert's age group due to a hip fracture and subsequent complications. Robert wasn't being punished for his driving. He was being charged for the statistical risk associated with his age. It felt personal, but it was just business. This is the harsh reality that catches so many senior drivers completely off guard. They feel penalized for simply getting older, despite being safer and more cautious than ever. But this does not mean you are helpless. You do not have to just accept these skyrocketing rates. There are powerful proactive steps you can and should take to fight back. First, and this is the most impactful, is to enroll in a mature driver defensive driving course. Organizations like AARP and AAA offer them, and they can often be completed online in just a few hours. In many states, including California, Florida, and New York, insurers are legally required to give you a discount for up to 3 years upon completion. This is a guaranteed way to lower your premium. Second, this is the perfect time to critically reevaluate your coverage. If you're like Robert, driving a 10-year-old car that's paid off and worth maybe $6,000 or $7,000, do you still need to pay for full collision and comprehensive coverage? The cost of that coverage over a year or two might be more than the car is even worth. Consider raising your deductibles or, if your financial situation allows, dropping those coverages entirely and banking the savings. Third, embrace technology. This is a big one. Many seniors are hesitant to use usage-based insurance programs, where a small device or a smartphone app monitors your driving habits. But if you are a genuinely safe, low-mileage driver, this is your silver bullet. This technology provides the insurance company with real data about your driving, not the generalized statistical data of your age group. Can prove you don't drive at night, you don't speed, you brake gently, and you drive very few miles. This can lead to massive discounts that completely offset the age-related rate increases. Fourth, and this applies to everyone but is especially crucial here, shop around. Loyalty is rarely rewarded in the insurance world. Some companies are far more aggressive in pricing for senior drivers than others. One company might see a 75-year-old as a huge liability, while another might have a different algorithm that values your clean record more heavily and offers a much more competitive rate. Get quotes from at least 5 different carriers. Finally, consider your vehicle. When it's time for a new car, prioritize one with the latest safety features. Things like automatic emergency braking, blind spot monitoring, and lane keep assist are proven to reduce accidents. Not only do they make you safer, but they also trigger significant discounts from most insurance companies, helping to counteract the age factor. So while age is a powerful factor, it's not the only thing misunderstood on your policy. In fact, one of the most confusing and widely misinterpreted parts of any insurance contract is a single 2-word phrase that millions of Americans think protects them from being sued. They believe it means no one is to blame. But in reality, no fault doesn't mean what you think it means. And misunderstanding it could cost you everything after an accident. It's a system designed not to erase blame, but to change who pays first. In the vast majority of the United States, we operate under what's called a tort system, or an at-fault system. It's simple. You cause a crash, your insurance pays for the other person's injuries and car damage. You're at fault, you pay. But in 12 specific states, things work very, very differently. These are the no-fault states. And what this term actually refers to is a requirement that drivers carry a specific type of coverage called personal injury protection, or PIP. Here's the bombshell. In a no-fault state, if you are injured in an accident, it doesn't matter who was at fault. You don't start by filing a claim against the other driver. You are legally required to file a claim with your own insurance company first, using your own PIP coverage to pay for your initial medical bills and lost wages. Think about that. Someone runs a red light, T-bones your car, and sends you to the hospital. And the first phone call you make isn't to their insurance company to demand they pay. It's to your own company to use the coverage you pay for. The system is designed this way to get injured people their medical payments faster, without waiting for a lengthy investigation to determine who was to blame for the accident. It's supposed to reduce the number of small lawsuits clogging up the courts over minor fender benders. But, and this is the multi-million-dollar but, this no-fault protection is not a magical shield. It has a limit, a very firm and unforgiving limit. Once the injuries from an accident become serious, the no-fault system shatters, and you are thrown right back into the traditional world of blame, liability, and lawsuits. Every no-fault state has what's called a threshold. This threshold can be monetary, meaning your medical bills have to exceed a certain dollar amount, say $5,000. Or it can be a verbal threshold, meaning the injury itself has to meet a definition of serious, like a permanent injury, significant disfigurement, or a fracture. Once you cross that threshold, all bets are off. The no-fault label becomes meaningless. You can now sue the at-fault driver for your medical expenses that exceed your PIP coverage. You can sue them for pain and suffering. You can sue them for everything you could in a normal at-fault state. And that means they can sue you too. The person who was deemed responsible for that serious accident is still on the hook, personally and financially, for the damage they caused. Believing no fault means no blame is like believing a life raft is an aircraft carrier. It might help you in a small splash, but it offers zero protection in a real storm. Let's make this real. Imagine two drivers. We'll call them David and Maria. David lives in Dallas, Texas, an at-fault state. Maria lives in Miami, Florida, a classic no-fault state. They both have identical, good insurance policies. One afternoon, they both get into the exact same accident in their respective cities. A driver runs a stop sign and plows into their driver's side door. Both David and Maria suffer a severe back injury, and the other driver in both scenarios is clearly 100% at fault. Let's follow David in Texas first. The process is straightforward. The police report says the other driver is at fault. David's lawyer contacts the at-fault driver's insurance company. That insurance company's bodily injury liability coverage is now on the hook for David's hospital bills, his months of physical therapy, the wages he lost from being unable to work, and a settlement for his ongoing pain and suffering. Their property damage liability coverage pays to repair or replace David's car. It's clean if not simple. The person who caused the harm pays for the harm. Now let's switch to Maria in Miami, in the no-fault state of Florida. The accident is identical. The other driver is 100% at fault. But Maria's journey is completely different. For her initial medical treatment, the ambulance ride, the emergency room visit, the first few doctor's appointments, she doesn't turn to the at-fault driver's insurance. She has to file a claim under her own personal injury protection, or PIP coverage. In Florida, this is typically $10,000. So, the first 10 grand of her medical bills and lost wages are paid by her own policy, the one she pays a premium for every month. The at-fault driver's insurance hasn't paid a dime towards her injuries yet. This is where the myth trips people up. They think this is the end of the story. But Maria's back injury is serious. It requires surgery. Her medical bills quickly soar past the $10,000 PIP limit. She has now officially crossed Florida's threshold for a serious injury. And in that instant, the no-fault shield evaporates. Maria's case now transforms into a traditional liability claim, just like David's in Texas. She can now, and absolutely will, sue the at-fault driver for every penny of her medical bills above her $10,000 pay limit. She will sue for all of her future medical needs, her lost income, and for the immense pain and suffering caused by the injury. The at-fault driver who hit Maria, who might have been driving around thinking, it's a no-fault state, is now facing a lawsuit that could potentially reach hundreds of thousands, if not millions of dollars. Their bodily injury liability coverage is all that stands between them and financial ruin. And there's one more critical twist that almost everyone gets wrong. The no-fault rule only applies to injuries to people. It has absolutely nothing to do with damage to vehicles. Never has, never will. When Maria's car was smashed in Miami, the at-fault driver's property damage liability insurance was responsible for the repairs from the very first second. Fault is always assigned for property damage, even in a no-fault state. So you have this bizarre hybrid system where one driver's insurance is paying to fix your car, while your own insurance is paying to fix you. So, who needs to worry about this? The 12 no-fault states are Florida, Michigan, New Jersey, New York, Pennsylvania, Hawaii, Kansas, Kentucky, Massachusetts, Minnesota, North Dakota, and Utah. Puerto Rico also uses a no-fault system. And in 3 of those states, Kentucky, New Jersey, and Pennsylvania, it's actually a choice system where you can opt out of the no-fault restrictions, but that's a whole other layer of complexity. If you live in one of these states, you cannot afford to misunderstand this. No fault is not a get-out-of-jail-free card. It is a procedural system for small claims. For big claims, it's a full-contact sport, and blame is the only thing that matters. Understanding this distinction is crucial, because it directly impacts how much insurance you need to carry to protect your own assets. But this brings us to the single biggest, most expensive myth of all. It's a belief that leads millions of drivers to be dangerously underinsured, thinking they're protected when they're actually one bad accident away from total financial ruin. It's the myth of the full coverage fallacy. And it's called the full coverage fallacy. This is, without a doubt, the single most misunderstood and dangerous phrase in the entire world of auto insurance. It's a ghost, a phantom, a marketing term that has no actual meaning in a legal insurance contract. Yet it lulls millions of us into a false sense of total security. When you tell your agent, just give me full coverage, what you're picturing is a magical impenetrable shield. You believe that no matter what happens, a fender bender, a hailstorm, a multi-car pileup, a medical emergency, your insurance company will step in and make you whole. You think you've checked the cover everything box, but you haven't. That box doesn't exist. Here's the truth. In the insurance industry, full coverage is just lazy shorthand. It's an informal phrase agents use to describe a policy that includes three basic components: liability, collision, and comprehensive. That's it. Let's break down what those three things actually do, and more importantly, what they don't. First, you have liability coverage. As we discussed with the state minimum myth, this pays for damage you cause to other people and their property. If you run a red light and T-bone a brand new Escalade, your liability coverage pays to fix or replace their $60,000 SUV. It pays for their medical bills when they go to the hospital. It does absolutely nothing for your car or your injuries. It is purely for the damage you inflict on others. Second, you have collision coverage. This is the part that pays to repair or replace your car if it's damaged in a collision with another vehicle or an object, like a guardrail, a pole, or a building. This coverage applies regardless of who is at fault. So, in that Escalade accident, after your liability paid for their car, your collision coverage would kick in to fix your car minus your deductible. If you have a $1,000 deductible, you pay the first grand, and the insurance covers the rest. Third, there's comprehensive coverage. Think of this as everything else that isn't a collision. This covers damage to your car from events like theft, vandalism, fire, flooding, hail, or hitting an animal like a deer. A tree branch falls on your car during a storm? That's comprehensive. Someone keys your door in a parking lot? Comprehensive. Your car gets stolen? Comprehensive, again minus your deductible. So, when you have liability, collision, and comprehensive, you have what the industry calls full coverage. And it sounds pretty good, right? Sounds, well, full. But this is where the financial trap is sprung. The danger lies not in what full coverage includes, but in everything it leaves out. Having this basic trifecta of coverage is like building a house with walls and a roof, but forgetting to install locks on the doors, windows, or a fire alarm. You're exposed in ways you can't even imagine until it's too late. So what's missing from this so-called full coverage? Let's open the door to the hidden gaps in your policy. The first, and arguably most critical, missing piece is uninsured or underinsured motorist coverage. Let this sink in. The Insurance Research Council estimates that 1 in 8 drivers on the road in the United States is uninsured. That's nearly 13%. In some states, it's over 20%. That means the person texting in the lane next to you might have zero insurance. So let's say one of those uninsured drivers blows through a stop sign and plows into you. They total your car and send you to the emergency room with serious injuries. Their fault 100%, but they have no insurance. They might be a judgment-proof individual with no assets to their name. Who pays for your brand new car? Who pays for your tens of thousands of dollars in medical bills and lost wages while you recover? Your full coverage liability? Nope, that's for damage you cause. Your collision? Okay, that will cover your car, but you still have to pay your deductible, and it does absolutely nothing for your medical bills or your lost income. This is where uninsured motorist coverage becomes your financial life raft. It steps in and acts as the insurance the other driver should have had, covering your medical expenses, your pain and suffering, and your lost wages. Underinsured motorist coverage is similar. It kicks in when the at-fault driver has insurance, but their low-limit policy isn't enough to cover your massive bills. Without this coverage, you could win a lawsuit against the other driver and be left with a worthless piece of paper, while your life savings are completely wiped out by medical debt. What else is missing? How about medical payments coverage, often called MedPay, or in some states, personal injury protection or PIP? This is your immediate first aid for expenses. MedPay covers medical bills for you and your passengers, regardless of who was at fault in an accident. There's no waiting for lawyers to argue or for fault to be determined. You go to the hospital, you show your MedPay coverage, and the bills get paid up to your limit. It's fast, it's simple, and it prevents medical bills from going to collections while the bigger insurance claim is being sorted out. Next up, rental reimbursement. Your car is your lifeline. It gets you to work, to the grocery store, to your kids' school. Now imagine it's in the repair shop for 3 weeks after an accident. Your full coverage policy does not automatically pay for a rental car. You'll be paying $30, $40, $50 a day out of your own pocket for a rental, or bumming rides from friends unless you added this specific and usually very inexpensive coverage. And what about gap insurance? If you have a loan or a lease on your car, this is non-negotiable. Remember, insurance pays the actual cash value of your car at the time of the accident, what it's worth today, not what you paid for it or what you owe on it. Cars depreciate fast. It is incredibly common to owe more on your loan than the car is actually worth. This is called being upside down. Let's say you owe $22,000 on your car loan. You get in a wreck and the car is totaled. The insurance company determines its current market value is only $18,000. They write a check for 18 grand to your bank. You now have no car, and you still have to write a check for $4,000 to the bank to pay off a loan for a vehicle that is now a cube of scrap metal. Gap insurance is designed to cover that exact gap, paying off the $4,000 difference and saving you from financial disaster. It is almost never included in a standard full coverage package. So you see, the myth of full coverage is a dangerous oversimplification. It stops us from asking the right questions. It makes us passive consumers of a product that is designed to protect our entire financial well-being. Let's quickly recap the 5 myths we've shattered. Myth number 1. Red cars cost more to insure. A complete fiction. The color of your car has zero impact on your rates. Myth number 2. New cars are always more expensive to insure. False. Modern safety features on new cars can often lead to lower premiums than some older, less safe models. Myth number 3. Your insurance follows the driver. No, your insurance follows your car. When you lend your keys, you are lending your insurance policy. Myth number 4. State minimum liability is enough protection. Absolutely not. It's a financial trap that leaves you one moderate accident away from potential bankruptcy. And myth number 5. Full coverage means you're fully covered. The most pervasive myth of all. A vague marketing phrase that hides massive gaps in your protection, leaving you exposed to uninsured drivers, medical debt, and crippling loan balances. So what is the solution? It's simple. Banish the phrase full coverage from your vocabulary forever. When you talk to your agent, do not use those words. Instead, you need to become an active participant in building your policy. Talk in specifics. Pull out your policy's declaration page tonight. Don't look for the words full coverage. You won't find them. Instead, look for the numbers. What are your liability limits? Are they 25/50/25? Or are they 250/500/100? Do you see a line item for uninsured/underinsured motorist coverage? If so, what are those limits? Are they high enough to protect your family? Do you have medical payments coverage? Do you have rental reimbursement? If you have a car loan, do you have gap insurance? Call your agent tomorrow. And don't ask for a quote on full coverage. Ask them to walk you through each individual coverage. Ask them to explain what happens if you're hit by an uninsured driver. Ask them what your collision deductible is and how much you'd save by raising it. Ask them to quote you the price to add rental and roadside assistance. You have to be your own advocate, because insurance isn't just a legal requirement you check off a list. It is a personalized shield for your assets, your health, and your family's future. Building the right policy isn't about buying a product. It's about managing your personal risk. By understanding these myths, you've taken the first step from being a passive buyer to an empowered protector of your own financial life. You now know the right questions to ask to ensure your shield has no cracks. Thank you so much for joining me on this deep dive. If this video helped you see car insurance in a new light, hit that like button and subscribe for more content that puts you in control. And drop a comment below. Let me know which of these myths surprised you the most. Now go check your policy, because the most expensive accident is always the one you're not truly prepared for.